Hey Samuel, what's your first investment? So, what is the best investment for someone who wants to start working on their finances? If you're a beginner and you just started working, you must be wondering, where on earth should you invest your money? Where's the best place to keep your money? Looking back those days when I got my first job, I too had the same question. I wanted to start investing early. But the big question is this: where is the best place to invest my money?
Insurance policy.
Insurance?
Unit trust.
As soon as I got my first paycheck, I really wanted to figure out how should I start investing my money. Sorry, just a moment. Hello? Sorry, I'm not interested. Thank you. So, you also probably got a call like this before. I was referred to by my friend whose cousin just joined an insurance agency and he wanted to share with me some financial ideas. I thought to myself, why not? Maybe I can find out where's the best place to invest my money. When we first met, he gave me a very attractive presentation about an insurance investment product. It went something like this: just save 10,000 ringgit a year, and by the end of the year, I will guarantee get back 4,000 ringgit. And then after 20 years, my capital will double. Wow, that sounds like a fantastic deal, isn't it? But the real question is this: is it a good investment that's worth your money? If you were to really sit down and analyze the number, you will find that the actual return of this kind of plan usually is around 1 to 4%. Now it doesn't sound as attractive anymore, right? It's kind of like putting your money into a fixed deposit account, but with a longer lock-in period and a penalty if you were to withdraw that money earlier or you were to stop investing halfway. So I personally think that it is a good investment choice if you really lack the discipline of saving money. Maybe you're the kind of person who at the moment you get your money, you will spend everything and you will never be able to save. Then yeah, this kind of penalty and this kind of long lock-in period may serve as a better motivation for you to start saving. However, if your purpose of saving is to maximize your return and you have no problem disciplining yourself to save, then this kind of insurance investment plan may not be that much of a good choice for you.
It is what it is. It is what it is.
Honestly, insurance plans can be very, very complicated. And if I were to really go into it and talk about it, it can take us a long time. So if you really want to know more, tell us in the comments and we'll probably make a video about it. Now, back to my story. After hearing about different insurance plans and so on, this is how I decided to invest in insurance. Personally, I'm using an investment-linked plan. Simply because it has more flexibility compared to a term plan. This way, I can tweak the policy components to customize for a suitable benefit for myself and my family. At the end of the day, for me, insurance is about providing me with protection. So I will always maximize my insurance benefit and minimize my investment component in the investment-linked plan. In fact, actually, I don't really care if I can get back any money from my investment-linked plan. Because the way I see it, insurance plan is for my protection purpose. It's not for any investment return. So I don't really care whether at the end of the day, my investment-linked plan can provide me with a good return or not. And since I don't think I got any severe discipline problem in saving up my money, I don't think I need some forced insurance saving plan that will lock my money away for a long years and then implement some penalty for taking my money out early. In fact, I need the flexibility to withdraw that money to invest into other investment opportunities when I see fit. So, insurance investment plan is not for me.
What do you mean no?
I mean no, you want to hear it in Spanish? No.
So, after meeting that agent, I actually got a next call from another friend who just joined the unit trust industry. When we met up, he shared with me about how unit trust is a good investment plan and how their company is the #1 unit trust company in Malaysia. He even pulled out many charts and showed me many numbers, telling me that if I can save X amount every month, then by the time I retire, I can amass this kind of wealth. Again, that sounds like a fantastic investment idea, right? Just regularly save your money and then at the end of the day, you get to retire comfortably. But again, is unit trust really a good investment option for a beginner like me? Well, before we go on further, let's talk a little bit about unit trust. Some people call it unit trust, some people call it mutual fund. Either way, it is a pool investment vehicle. The idea here is you chip in your money into a pool of capital. Then a professional fund manager will invest this money according to the mandate given to them. The mandate is basically a set of instructions that details the investment objective, the type of assets that they are allowed to invest in, and the general investment strategy strategy that they can use to employ the capital. But in return for this professional service, you have to pay an annual management fee. Usually it's in between 1% to 2%, depending on the type of fund that you're invested in. On top of that, if you're using a human advisor to invest, then you probably have to pay out another 5% in sales charge upfront. So if you invest around 10,000 ringgit, you are actually investing only around 9,500 ringgit. Talking about the subject of unit trust, whenever I meet people who invested in unit trust, they like to tell me this thing. Oh yeah, I got invested in unit trust and I invest in this brand A unit trust. Then I will follow up with this question: which fund are you invested in? And here's where they don't even know which fund are they invested in. Well, the thing is this: brand A will have many funds under their management, and not all funds are the same. So every fund will have a different performance.
There are too many of them. What are we going to do?
So it's really important to know exactly which funds are you invested in. Some funds have an objective to provide capital returns for their investors, and usually these kind of funds are called the growth fund, and generally they are invested in the stock market. Then there are also some funds whose their objective is to provide yearly regular income to their investor, and these type of funds are often called income fund, and usually they are invested in dividend stocks, REITs, or even bonds, basically assets that can generate consistent yearly return. There are even certain funds who specifically invest in Asia stock market, some specifically into the US stock market, and some focusing on China tech stocks, and so on and so forth. There are literally thousands and thousands of funds that you can choose from today. So the type of funds that you choose to invest in will determine the possible return that you can get from your investment. This depends on the investment class that they are invested in. So here's a rough guide for you on what can you expect. Usually a bond can produce around 2 to 5% return, then equity, which can produce around 6 to 10% return, then aggressive growth funds, which is also investing in stock market but higher risk. They can potentially generate around 12% and above. Before we go on further, I would like to get your permission to talk about our sponsor for this video, which is Manulife Investment Management Berhad. Now, if you have been following our content, you would know that I always believe that unit trust has a place in everyone's investment portfolio, even if you're a stock investor. And for those of you who would like to invest in unit trust, but you don't like the hassle of meeting an agent, today you can invest through Manulife iFUND. It is an online investment platform that enables you to select, manage, and track your Manulife unit trust fund anytime, anywhere. It's an easy investment on the go. And if you prefer to use the dollar cost averaging method to invest your money, well, you can use their regular saving plan feature on the platform. That way, your money will be automatically sent to work for you every month. Now, they're currently running a promotion where you can earn up to 200 ringgit e-voucher when investing online via the Manulife iFUND platform until the end of this month. So if you're interested in investing in unit trust fund and you also like to support our channel, do check out the link in the description below for more information. So, back to my story. Do I find unit trust a good investment for myself? Well, the answer is yes, because it helps me to achieve certain investment objectives. Firstly, it gives me exposure to certain markets that I won't be able to invest with my very limited capital, such as the China market and global market. If I were to invest in those markets myself, it will not be economical because my capital is so small. Secondly, I may not have the ability to filter out the necessary information needed to make a good investment decision, especially when I first started investing.
I don't know. That's nice.
So having a professional team to do that for me is a good idea. And third, it also allows me to do regular investment, namely dollar cost averaging, which is a method that I prefer when investing through unit trust funds. So every month, my money is automatically transferred to the fund, making it convenient for myself and automated as well. From there, I will just regularly review my fund performance, which is pretty straightforward once you understand how to read a fund fact sheet. So, can it be a good investment for you when you're starting out? Well, that really depends on yourself. There are many types of unit trust out there. I'm sure there'll be one that's suitable for you, but you need to find out.
Daddy's gotta go to work.
Now, I believe some of you are thinking right now, the fees for unit trust is so high. Is it actually worth it? And are there other options?
What's up, everyone?
Today, in this video, the investment vehicle
Robo advisors.
Well, when I first started working, there were no robo-advisor. Robo-advisor only came out in the last few years. And in Malaysia, it was made famous through StashAway. But today, you have so many other options such as Bursa, Akru, MyTeo, and so on. So, is it really the best choice for a beginner to start investing through robo-advisor? Well, let's take a look at what a robo-advisor actually is and what does it do. Remember earlier, I mentioned about those people who call me and ask me out to talk about their financial idea. Their job was to understand my needs and advise me on how to and where to invest my money. And they're usually referred to as financial advisors. Well, the idea of a robo-advisor is to replace them. Why? Because their commission is higher and a robo-advisor charges a much lower commission or fee, which usually is less than 1%. Comparing to a human advisor, it's definitely higher. But at the end of the day, robo-advisors are not an asset. They're actually just like human advisor to help you to invest your money into different assets, whether it's stock, bond, or even unit trust. Most of the robo-advisors that we have seen in Malaysia helps us to invest in index funds or ETF, which is kind of like a unit trust fund. But then the fund manager will take a passive investing approach. The idea of an index fund is to provide return that is similar to the average performance of the market. In other words, they call this benchmark performance. It is like the S&P 500, which track the performance of the 500 largest companies that are listed on the US stock market. Since they are taking a more passive approach, index funds and ETF have a lower management fee, and usually it's less than 1% compared to the more actively managed unit trust funds, which is around 1 to 2%. So, with a low fee from robo-advisor plus a low management fee from the fund, the total fees that you're paying are lower than a unit trust fund. Because of this low fee, robo-advisor recently has really catch on the trend. Some people are even saying it's better to just invest your money into ETFs and robo-advisors. It is much better than investing in unit trust funds. But is that the case? Now, back to myself, I personally invest in both. And I invest in both of them regularly. Yes, like every month. I use robo-advisor because it allows me to invest in a number of global ETFs at a low capital. If I were to invest individually in each of these ETFs, it will not be financially possible for me.
I can't eat! I'm broke! I'm broke!
On top of that, I also see the passive investment approach as a hedge against my other more aggressive investments like unit trust and stock. This works like a safety cushion for my investment. But at the same time, I'm young and I have a longer time horizon for my investment. So I want to maximize my returns through active investment as well. That's why I invest in unit trust too. I know many people will say that 90% of active investment funds are performing worse than index funds. They are right, but don't forget, there are still 10% of funds that are performing very well, and some of them are outperforming passive ETFs and index funds consistently. Sometimes they can give 15% to 35% return a year. So even though the management fee for an active unit trust fund is higher at about 2% compared to a 1% fee on an index fund or ETF fund, I don't mind paying a higher management fee for a much better return. I personally think that these are some of the easiest investments for a beginner to start with, because it doesn't require much capital and you don't need to do some extensive research before you start investing in them. At the end of the day, you can always start small and learn along the way while you accumulate capital to invest in bigger items such as properties or stock. So, which is the best investment for you? If you're someone who just can't control yourself and you will spend all the money,
can't keep my hands to myself,
maybe insurance investment is a good choice for you, because it's probably better to lock your money away and get lesser return than saving nothing at all at the end of the day. Or if you dislike talking to a human advisor and you prefer a more passive investment approach, maybe ETF and index fund is a good choice for you, and you can do that through a robo-advisor. But if you don't mind taking some risks and you don't mind paying a little bit more fees and you manage to find a good fund that can give you great returns, then unit trust fund could be the right choice for you. For myself, I see my own financial plan like a football game. It has to be diversified, so each investment tool has its purpose. In my case, the Defender is like the investment linked plan, just in case if anything goes wrong with my health, I got money. And my midfielder is like the robo-advisor who invests in ETF passively. And then I have a striker, which is my unit trust funds who are performing well and giving me good returns. So even though all these three investments are different, they actually have one goal when I'm using them, which is to win the match. So what are some other investments that you would like to learn about? Tell us in the comment below and we'll pick it up and talk about it the next time.